Yeah, hi Rich. Hi everyone. I do have a rate update, and as Rich mentioned, rates are going up. So today on a conforming loan limit, 726,200 for these are all quoted for Orange County. The rates are between 7.375 to 7.75, and that's with 0 to 1 points being charged. High balance, so this would be anything above the 726,200 up to 1,089,300. The rates are about 7.806 to 8.25. And jumbo, so anything above the 726,200 would be about 7.625 through 8.375. The next Fed meeting is the end of this month. They are expected to raise the Fed rate again. They really want that inflation rate to be about 2% or lower. I think currently right now it's at 3.67, so we're not there yet. And the general consensus, our rates are going to be higher for a while.
Yeah, it looks like. Yeah, I think the other thing that's going to continue to keep rates high, the so-called Inflation Reduction Act. Remember that was what, 1.4 to 1.7 trillion?
Inflation Creation Act.
Yeah, another name for it, right? And with that said, that means the government's going to be borrowing more and more. And it doesn't seem as if there's any Fed intervention in terms of the Fed buying these treasuries. So there just isn't much demand for treasuries, and mortgage rates tend to follow the yield on the 10-year treasury. So I don't think we're going to see, I agree with Sarah, I don't think we're going to see any type of dramatic reduction in interest rates, certainly not for the rest of this year. And maybe into next year, it's probably going to be somewhat consistent with what we're seeing now. But the sell-off in the bond market has been dramatic. So if it's selling off, rates have just gone up dramatically. Sarah, would you say in the last week it's probably gone up 1/4 to 3/8 of a point in interest rate?
Yeah, that seems about fair. And I mean, I do have an example of a buy down. I know you had asked me at the last meeting, so just to kind of give everyone an example. So for those who don't know what a buy down is, there is an opportunity to buyers to buy down the rate with the help of using a seller concessions. So for example, a 1-year buy down, if the rate was 7.375, you could buy it down to 6.375. The total savings in payment is about $485 a month. And how that translates is that the seller would need to give a seller credit of about $5,822 in order for the buyer to use that to buy down the rate. But, it's a good opportunity to get some savings for the buyer, for the first year. I do know that sometimes it can be a little bit hard to get that concession, depending on what the other offers look like from other buyers, though.
And then, Sarah, could you just describe what rate they qualify at with the buy down?
You qualify at the fully indexed, the full note rate. So in this case, you'd be qualifying at the 7.375.
So just keep that in mind when you're working with buyers, even though you can have the rate bought down, they're still going to qualify at what the fully adjusted rate would be. So there's no benefit there. What about FHA financing, Sarah? What are the rates on that? Do you know?
FHA, they tend to be about maybe like half a point lower. The only thing with FHA is that sometimes the mortgage insurance will tend to be a lot higher than what it would be on a conventional loan. But there are benefits to doing an FHA loan, such as far as, it allows for a higher debt to income ratio. The minimum down payment requirement is 3.5%. Sometimes it can allow you to go higher on the conforming loan limit, depending on what the borrower qualifies for. There is some talk too, though, actually, that next year the loan limits should be increased. Some are saying that the conforming loan limit should be somewhere above $750,000 next year.
And then assumability for FHA and VA loans, does it exist?
It does exist. I've actually had this scenario come up quite a few times. One thing to kind of keep in mind is that there's usually going to be some type of assumability fee that's charged by the current lender. They also have to qualify for the loan with that current lender. And then they would be required to bring in the difference. So, for example, if a house is selling for, let's just say $1 million. The existing FHA loan on there is about 500,000. The difference between the existing FHA loan and the sales price still needs to be brought in by the borrower.
So a thought would be, because there could be some exceptionally low interest rates for FHA or VA loans, there aren't many other loans that seem to have an assumability clause associated with them unless it's an adjustable, and we didn't see many adjustables. And we don't see a lot of government loans in Orange County, but that might be something to give consideration to when you're looking at farming activity. That certainly is a great feature for somebody who's giving consideration to selling their property, is you can offer an interest rate today to somebody, a buyer, that they can't get anywhere else possibly if that person took out an FHA or VA loan in the last couple of years. So that's something to keep in mind, right? It could be a tool that you might be able to use. The veteran themselves, Sarah, if it's an assumable loan, do they have any responsibility subsequent to that?
On a VA loan, I would have to double check that.
Okay. John Sheehan,
no.
right? John, so what takes place with assuming a veteran's loan is assumed? Are they still responsible for that loan in some capacity? Or do they lose their ability to move on to use a VA entitlement once again? He's muted. Okay, John, you're muted. Maybe we can address that next time.
Are you talking to me or John Pasola?
To you, John Sheehan.
Okay. No, in order to get your eligibility, you get the release of liability off the first loan that you have. You have to get that release in order to use it again.
But if the loan is assumed, can you get the release?
No.
That's the answer I was looking for.
Yeah.
Okay. And without the release, the vet can't use that eligibility once again, correct?
Correct.
Okay. All right. All right, so just things to give consideration to. Thank you, Sarah. Thank you, John. Appreciate it. Good morning, everybody. How are you today? So this is not a new subject, but we're going to talk about capital gains taxation and we're really talking about more so in regards to real estate, and especially principal residences. We'll touch upon investment properties also, but what happens if I sell my principal residence? What's available to you? Well, there's the possibility of a $250,000 or $500,000 exclusion in regards to the gain when filing your tax return. And you'll always see Internal Revenue Code section 121. So that's what's going to be something you'll see quite often, a lot of documentation. All right, if I can get that to move. And then let's see, can you use the exclusion more than once? Yes, you can. You can use it, but you can't use it more than once every 2 years. So if you've used the exclusion within the preceding 2 years, you can't use the exclusion once again when selling your current principal residence. And then remember, there are certain qualifying features. You must have owned and occupied the property for 2 years, but there are some exceptions to that. And then questions that still come up today. Can I use an exclusion in connection with Internal Revenue Code section 1034, rollover of gain on the sale of my principal residence? A 1034 rollover of gain is similar to a 1031 exchange, except law was in place before. If I sold my principal residence, I could just roll the gain over into a property of greater or equal value. That doesn't exist any longer. So I just wanted to bring that up because people my age are going to be asking you those questions, right? They used to exist at one time, and it no longer is available to anybody. And then another exclusion, a one-time exclusion that was available to homeowners, was a $125,000 exclusion of gain from the sale of a property if you were age 55 years of older. And that also had been repealed a number of years ago. So that does not exist. So 1034 rollover for a primary residence doesn't exist. And $125,000 exclusion of gain for someone who's age 55 years of age or older does not exist. If I did use $125,000 exclusion of gain in the past, am I prohibited from using the $250,000 exclusion for a single filer or $500,000 exclusion for a married couple? It doesn't matter. You just have to meet the qualifications. And for a married couple, the qualifications for the $500,000 gain include that either spouse must have owned the property for 2 years. So ownership, either spouse, 2 years ownership. Both must have occupied the property for 2 years, and neither spouse has used the exclusion during the preceding 2 years to take advantage of that exclusion. So if I marry someone who has used the exclusion within 2 years prior to our marriage, even though your spouse has used the exclusion, let's assume you're remarried and your spouse used that $250,000 exclusion or their exclusion during the preceding 2 years. The other spouse who didn't would be eligible to use a $250,000 exclusion. But once 2 years passes for the spouse who used the exclusion, the full $500,000 exclusion would be available to the married couple. And then another thing that happens all the time in our lives, if my spouse dies, must I sell our principal residence within the year of my spouse's death to take advantage of the $500,000 exclusion from gain? Anybody want to venture a guess on that one?
Yeah. Yeah.
Okay, I got a yes out there. So so you don't have to sell by the time they die. You have a 2-year time frame from the date of death in which you can use the exclusion. But still, the ownership and use requirements must have been met. Keep that in mind. And what if I move before I've occupied my residence for 2 years, or before 2 years have elapsed since the last time I sold or exchanged my principal residence? So remember, to meet the guidelines of use of full exclusion, it's the ownership, use, and use test. And then in addition to that, so 2 years for each, right? But I have to sell my property for some reason. Maybe I have a job relocation. You're entitled to a pro rata portion of the exclusion. Let's see, I'm going to bring up an example here. I can hear you over there. So let's look at the example I have on the screen. So Ms. Seller purchased and occupied her principal residence in 2021. 1 year later, she's transferred by her employer to another city and sells her house for around $100,000 gain. Because she occupied her residence for 1/2 of the required 2 years, she's entitled to exclude up to 1/2 of the $250,000 exclusion, or $125,000, thereby covering her entire gain. So there are certain exemptions that will allow you to take a pro rata portion of the exclusion against the capital gains that you are experiencing. So the exclusion associated with our example is that portion of the $250,000 or $500,000 exclusion equal to the fraction of the 2 years that the ownership and use requirement is met. So that means if I occupy the property for 1 out of 2 years, I would simply multiply 50% times the $250,000 exclusion if I'm a single filer. That's the maximum amount of money I can exclude. So in my example, I lived there for 1 year as a single individual. I have to move because of certain reasons that give me an exemption. I can exclude up to $125,000 of the gain on the sale of the property. Now in our example, her gain is $100,000 and would entitle her to exclude the full $100,000 of the gain. And of course, everybody's wondering, why are we talking about this? Because any seller is going to be talking to you about capital gains. That's why you have to have a clear understanding of what's available to them. So at least you can guide them.
Rich, would this also be true for a married couple? And you can, I guess use a $250,000 instead of $500,000 after 1 year?
It would be exactly the same. So Carlos is asking what happens if it's a married couple versus a single filer. Well, the pro rata portion of the exemption would still be available to them also.
So I think it's for health reason, job relocation, and then I think those 2 reasons.
Very good. Those are some of the exclusions, as a matter of fact. And of course, there's further clarifications to permissible reasons for sale exchange that allow a pro rata exclusion. Very good, Shweet. I'm going to go over those right now. So Treasury regulations do provide additional clarifications or safe harbors for exemptions from the 2-year period, meaning if I didn't live in the property for 2 years, there are other exemptions, or it gives me the ability to take advantage of excluding some of the gain if I sell my primary residence. So one of those is providing that the sale or exchange is by reason of a change in employment, health, or unforeseen circumstances, but only if the primary reason for the sale or exchange is a change in place of employment, health, or unforeseen circumstances. So the primary reason has to be for those reasons. You can't just say that's, if it's a secondary reason, then you most likely are not entitled to the exemption. And then the safe harbor is the reason it's in the code. It gives regulatory relief in the event you take advantage of that. So you can file for it and ideally not face any consequences. So we talked about a change of employment. So if you haven't lived there for 2 years, if you change employment, there are some safe harbors that are available to the seller. So if it's due to a change of employment, the individual's new place of employment must be at least 50 miles further from the residence sold or exchanged than was the former place of employment. So let me explain that. So my drive every day is 20 miles. And I've only lived in my house for a year. I've got a job transfer. Now my job transfer, if where I'm going to be moving to, is now going to be, has to be greater than 70 miles for my drive currently. So I drive 20 miles to work today. If I move and the total drive is now 70 miles, there has to be a 50-mile difference, I'm entitled to use the exemption. Also, that could occur if I change employment, or maybe I'm not employed and I move because I did get employment, or perhaps I'm going to be starting self-employment. So if I live somewhere, I'm not employed and I move, I only have to move 50 miles to be entitled to the partial exemption. If I start self-employment because I'm not employed today, if I move more than 50 miles, I'm entitled to a pro rata portion of the exemption.
How scrutinized is that during filing?
Well, that's a good question. I don't know. Your tax preparer would know the answer to that.
I just take a long way to work every day.
Yeah.
No,
And I don't know if it's based upon traveling or if it's as the crow flies, but I think I would be very conservative in regards to measuring that out. And then what if it's health reasons? Well, maybe I live here, but the only place that can help my heart condition is at the Cleveland Clinic, and I have to sell my property because of that. Well, that would entitle me to take advantage of the exemption. Maybe I lived in my house for 1 year and I need to sell because I need to relocate to Cleveland, because that's the only clinic that can take care of me. Well, that's a valid reason to entitle yourself to 1/2 of the exemption. Or your physician recommends it, not simply because I want to move to a warm and sunny state, or I want to live close to my kids, right? And then other exemptions that are available are unforeseen circumstances. Well, if your house burns down, or maybe you live near the freeway or the bullet train, and they're going to take your property through eminent domain, that could be another reason for you to take advantage of an exemption. And actually, even if you become unemployed and workers' comp benefits are available to you, that could be an exemption also if you haven't met the 2-year time frame. And then also, just like we have case law in the courts come to a jury, a verdict, and that sets case law, which attorneys will base their case on. Well, it's the same thing with the IRS commissioner. If the IRS commissioner has granted an exemption to somebody, then you can use that as another reason to exclude capital gains from your taxable income. Can I deduct a loss on the sale of my principal residence? No, you can't do that. And then if I have gains from the sale of my principal residence above the $250,000 gain or $500,000 exclusion limits, what tax will I pay? Well, that depends upon the tax bracket you're in. But capital gains rates today, hopefully everybody can see this. I put together some information just so you can see in regards to what the tax brackets will be for long-term capital gains. Now, to be subject to long-term capital gains, how long must you have owned that investment property? Anybody? 12 months. So if I've owned a property, could be stocks, could be a home, investment property. If I've owned it for 12 months, then taxation is going to be based on long-term capital gains tax rates, not short-term. So we can see in 2023, and this is based upon adjusted gross income, if I'm in a tax bracket and I'm a single filer, and my taxable income is $44,625 or less, I would pay zero capital gains on the property. And you can see 15% between income of or adjusted gross income, 44,625 to 492,300. I'd be taxed at a rate of 15%. And of course, over 492,300, the capital gains tax is 20%. But let's just compare that to short-term capital gains rates. So we're looking at this schedule. You can see 10%, 12%, 22%. Your tax is going to be, in the very first case, I'm going to pay 10% on the income between 0 and 11,000. I'm going to pay 12% on the income between 11,000 and 44,725, so on and so forth. But you can see how high the rates go, and it can be as high as 37%. So you can see where that holding period is critical in regards to reducing your tax liability. And then married finally jointly, you can see the thresholds are even higher. And these thresholds have been a little more beneficial than the 2022 tax rates. Thought you'd like to see that.
If you're like tenants in common and you're still filing taxes separately.
Then you're a single filer. So you're going to be that simple. Tenants in common, when she was asking, and if you're filing a tax return as a single filer, you are filing single, not married jointly. I guess you can also file, or if you're talking about somebody who's married or not married,
Not married.
not married, then single. That's simple.
How long is the short term?
Less than 12 months. Less than 12 months. So if you have stocks in your portfolio and you sell those within 12 months, that's an investment income or unearned income. And that's going to contribute to, you're going to be paying short-term capital gains rates on that investment income. But that does not even include Medicare tax, which could be an additional 3.8%. We'll talk about that when you're selling a property or selling stocks, so on and so forth. So any unearned income. And for those of us in this industry, it's critical if you have investment property that you can demonstrate that you're spending at least 500 hours a year in regards to managing your own property, because it converts that unearned income to earned income. And there's dramatic benefits associated with that. So what was that?
Can you say that again?
If you have an investment property, a home, and you're renting it out, and you spend less than 500 years, hours a year, 500 years, man. 500 hours annually or less than that, it's going to be deemed to be unearned income. And it could be subject to Medicare tax also, which is 3.8%. If you have a threshold of AGI of over 200,000 for a single filer, you're going to pay 3.8% on your net unearned investment income. If you're a married couple and your AGI, adjusted gross income, is more than 250,000, you're going to pay 3.8% Medicare tax on any net investment income also, or unearned income. But if you're actively engaged and you can document, you spend that much time, it's no longer unearned income. And it should be easy for all of us to document something like that, I would like to think. And then in regards to the $250,000, $500,000 exclusion, there are more special rules and exceptions. And a taxpayer can elect to not use the exclusion if they want. Maybe there's a reason for that. I'm just getting married and we're going to sell this other house. And maybe my benefit for the home I'm selling now is only going to be, it's going to be nominal. So maybe I want to save my exclusion. And then also, if somebody is incapacitated and they're in a facility, a nursing care facility, that also can be deemed to be the time in which you are occupying a primary residence to help you meet the 2-year requirement. And then we talked about an individual whose spouse is deceased on the date of the sale of the property. So if someone's spouse passes away Remember, they had the availability for the $500,000 exclusion if they sell the property within 2 years following the date of death. But the person who's deceased still must have met the 2-year occupancy and 2-year ownership requirement and not have used the exclusion during 2 years prior to that. So my spouse, I died, let's assume I died today, and in 2 years, my spouse sells the property. Well, during the last 3 years, I occupied their property. The exclusion is available to my spouse. But in those prior years, if I didn't occupy that as my primary residence, then only a $250,000 exclusion would be available to my spouse.
So even if it's not 2 full years,
That would be a pro rata exemption
I see.
possibility. So you would lose a portion, but then the exemption is only available. So let's assume some of the exceptions didn't apply to you, and I didn't live in there for 2 years. And if it wasn't because of health, unforeseen circumstances, or job relocation, I wouldn't have the availability of a pro rata portion of the exclusion. So what about if I transfer my property into a revocable trust? Well, assuming the grantor of the trust, meaning me, I'm transferring my property into the trust, and I have the ability to revoke that trust, then it's not considered to be a change of ownership, and you're still entitled to the $250,000 or $500,000 exclusion. But I have to maintain that control over the trust. So I can actually transfer to my trust, I can transfer back, assuming the ownership interest isn't any different, the $250,000 or $500,000 from capital gains exclusion is available to you. Any questions so far?
Would you please repeat the portion that you mentioned if your spouse is in a nursing home?
So the requirements, there's 3 basic requirements to be entitled to the $250,000 or $500,000 exclusion since we have a spouse. And that's the ownership. Only one of the 2 spouses must own. Both spouses must occupy the property. So if I'm incapacitated and in a nursing home, that can be included as part of me. They can deem that to be as if I occupy that home as my primary residence, even though I wasn't in that property during that period of time. And then utilizing a 1031 or a like-kind exchange in connection with an owner occupying a residence. Can you do that? No, you can't do that. But then there are those individuals who want to take advantage of tax planning, and they may convert a rental property into their primary residence. And then after living in it for 2 years, right, the ownership and use requirement, they sell it to take advantage of the exclusion of the $500,000 exclusion, for example. So if a property is acquired in a 1031 exchange, so I have an investment property, I sell it, and I complete a 1031 exchange successfully, so I have another investment property. I rent it out for a year, and I move into it for 2 years, is the $500,000 exemption available to me? Now, in that example, you must have owned the property for 5 years. If it's a property which you converted to a primary residence after completing a 1031 exchange. So I'll repeat that. I have an investment property, sell it, I buy another investment property, I move into it, I live in there for 2 years. Remember, 2 years is a requirement to take advantage of the exclusion. But in this case, when it's a 1031 exchange and a replacement property, I must have owned it for 5 years in that case and occupied it for 2 years to take advantage of the $500,000 or $250,000 exclusion. Did I explain that clearly? If not, please let me know so I can go through that again. I'm going to repeat it one more time just because.
This only applied to a investment property.
Correct, for a 1031 exchange. I've done something like that, as a matter of fact. So it works. But I'm not going to sell that property, but I'm going to convert to a principal residence. So remember, once again, I have an investment property. I sell it, I buy an investment property or replacement property. So I completed this 1031 exchange. And my intent is to move into there, and I eventually move into there. I occupy it for 2 years, and I really just want to sell it to take advantage of the $500,000 exclusion. I can do that, but I must have owned that replacement property for 5 years. Exactly. exactly.
It's only for 1031.
The 1031 exchange, yes. And I think we're going to see more and more. Let's face it, the population in California is aging. I think we're going to see a lot more people moving down. And this may be the ability for them to take advantage of some tax planning, as a matter of fact. Think about it. They could sell their primary residence, take advantage of the exclusion today. And if they had an investment property, sell it, roll it into a 1031. But I have to say, the one thing it doesn't exclude is depreciation recapture. Remember, when you're selling an investment property and you've taken depreciation, whether you take it or not, the IRS is going to conclude that you should have taken it. Then when you have a gain on the sale of the property, the $500,000 exclusion, for example, does not cover any of the depreciation recapture. So when you have an investment property and you sell it, you've depreciated it, assuming there's a gain on the sale of the property, you're going to pay 25% federal tax on the amount of depreciation that you've taken. So even in the scenario I painted for you, the $500,000 exclusion does not apply to depreciation recapture. You're still going to pay that 25% depreciation tax if you sell that property.
And that's a straight line?
Yeah.
30 years. 30 years.
30 years?
I mean, the straight line that they are the depreciation.
Well, that's a good question. There are accelerated methods of depreciation. If you made improvements to the property, depending upon the dollar amount, you can depreciate that or expense it in the year in which those expenses were incurred. But typically for depreciating a property, I think it's 27.5 years.
27.
And that does not, when you're depreciating a property, remember, you're depreciating the value of the structure, not the value of the land. There is no depreciation associated with land. So if you're aggressive and use an accelerated method of depreciation, the amount of tax you pay could be substantial. And how do you avoid depreciation recapture? Well, if you 1031 a property, that's about the only way. And then also death. So I have property and it's in my trust and I die. Well, my beneficiaries don't have to pay tax on any depreciation recapture. That's the only way to avoid it.
So if you live in 2 years, not 5 years, then it's gonna be correct.
That's a good question, as a matter of fact. So I'll get to that, but there's differences between something called qualified and non-qualified use. So non-qualified use is a time in which I don't occupy that property as my primary residence. Qualified use is a time in which I occupy that as my primary residence. So there's some exceptions, and I'll go through some examples. But that's a very good question. So let's address how capital gains exclusion is treated differently for the sale of a principal residence that was used as a second home or as income property during the ownership period. So for periods of ownership after January 1st, 2009, the exclusion from capital gains will be reduced, and this gets to your question, by the amount of the time the property was not used as a principal residence. And once again, that's non-qualified time. The gain from the sale will be allocated between periods when the property was used as a principal residence, which is qualified use. I live in it, it's qualified use, and the periods of non-qualified use. So, and I have an example we're going to go through. So the math is as follows. The gain is multiplied by a fraction where the numerator is the period that the property was used as a principal residence. That's the qualified use. And the denominator is the total period of ownership. So the formula is simple. It's gain times time of qualified use divided by total time owned. And that's the exclusion from capital gains. So let me bring up my example here. It's good timing, sir. So the first example, a married couple finally jointly purchased a vacation property on January 2nd, 2012, and they sell it on January 2nd, 2020 for a gain of $600,000. So I think we can all agree that's 8 years of ownership, right? During the last 2 years of ownership, they occupy the property as their principal residence. They would divide 2 years of qualified use. Qualified use is the time I occupy the property, by the total years of ownership, which was 8 years in total. and multiply that by their gain of 600,000. So the math is simple. 1 divided by 4 times 600,000 equals 150,000. So in this example, I could exclude $150,000 from capital gains. And assuming it doesn't meet the threshold of 500,000, I can deduct that full amount. And then the balance of 450,000 is taxable. So what we're talking about is what takes place with the property. I have a rental property and I've been renting it out. In this case, I've owned it for 8 years. I rented it for the first 6. Years 7 and 8, I occupied the property as my primary residence. I'm entitled to use a portion of the $500,000 or $250,000 exclusion for this property because I converted it to a primary residence. But you're not going to get, you're only going to be entitled to a pro rata portion of the exclusion. So 6 years of non-qualified use, that's when I rented it, 2 years of qualified use. So 2 years divided by total ownership of 8 times total gain. So $150,000 in our example, gain was 600,000. I can deduct or I can exclude from my income $150,000 of the $600,000 gain.
This one, it applied to 2 years and 5 years, the rule of it.
Yes, that's still right. You must have owned and occupied that or occupied the property for 2 out of 5 years, as a
Yes.
matter of fact.
So
in this
one
case-
is still, we have to go with the qualified, but we have to go with the formula.
In this case, yes, I met the ownership and use requirement because the last 2 years of ownership of the property, I used it as my primary residence. So I met the ownership and use requirement.
Okay.
So that's 2 out of the last 5 years in essence, right? A total ownership. So that's fine. I met that threshold to take advantage or use the exclusion. But you lose a portion of the benefit based upon the time you rented it out. That's the issue with this kind of formula, right? Did I answer your question?
Yes, but just want to make sure that I understand it clearly. But wasn't that the 1030? So this is not a 1031.
This is not a 1031
Okay,
exchange.
That only applied for 1031, that it's 2 years. out
And you
of the
must own it
5
for,
years
for 5.
without
Correct.
using a formula.
Correct. And then,
Because this is not a 1031, so we have to apply the formula.
yes, this is
Thank
not a 1031 exactly. But then also, if I have owned a property, if I lived in it and I occupied it for 2 years out of 5 years, that would entitle me to the $500,000 exemption. But there's other exceptions to the exemptions, which we're going to cover here. So are there exemptions from the non-qualified use rules? Remember, non-qualified is bad, right? It causes us to incur more tax. And there are exemptions to that. So the term period of non-qualified use, once again, means any period during which the property is not used as the principal residence of the taxpayer or the taxpayer's spouse or former spouse. So non-qualified, it was used as investment property, right? It's not a primary residence. But then there's an exception to that. And a term or period of non-qualified use does not include, and I'll give an example, any portion of the 5-year period, which is after the last date that the property is used as the principal residence of the taxpayer or the taxpayer's spouse. Also, other exemptions, if it's somebody in the military, for example, if they're stationed elsewhere, then the time that they're living elsewhere because they're stationed in Afghanistan, that's considered to be qualified use, meaning it's deemed to be the time in which they're occupying the property. But that can't exceed 10 years. So if you're working with somebody who's in the military, that could be a benefit to them also when they're selling a property. And then also change of employment, so on and so forth. So I think an example that I've got here is going to help us understand this a little bit better here. So in January 2009, married taxpayers filing a joint return buy a house and use it as their principal residence for the first 2 years. They then convert the residence to a rental for the next 3 years, after which they sell the residence and realize a gain of $600,000. So none of the 3 years of otherwise non-qualified use. So I bought it, I occupied it for 2 as my primary residence. I rented it out for 3 years thereafter. So none of the 3 years of otherwise non-qualified use after the initial use as a principal residence would be used to reduce the capital gains exclusion. So I'd be entitled to the full $500,000 exclusion when own capital gains on $100,000. So the exception is, now we went through the other example. I've owned the property for 8 years. First 6 years were rented. The next 2 years I occupied it. And I was only entitled to 1/4 of the exclusion. In this example, anytime within a 5-year time frame following the 2 years of which I occupied the property as my primary residence is also deemed to be qualified use, meaning they're going to look at it as if I also occupied that property. So I get the full benefit. So I've owned the property for 5 years. The first 2 years I occupied it. The next 3 years I rented it. And in that time frame, I sold it. They're going to look at that 5-year time frame as if I used and occupied that property as my primary residence. So that's the exception. You can see in the 8-year time frame, all the time preceding the time I occupied it as a primary residence, it reduced the amount of the exclusion, causing me to incur more tax. Whereas in this case, even though I rented out for 3 years following the 2 years in which I occupied it, I get the full benefit of the $500,000 exclusion.
So it's 2 out of 5 years if you leave it, even if you rent it to somebody else.
Yes.
It's still you.
And in your example, your question, so right, to take advantage of the $500,000 exclusion, I had to have occupied that property for 2 out of the last 5 years. It doesn't have to be consecutive, but let's assume I occupied it for 2. I rented it for 4 because I'm not meeting the 2 years occupancy out of the last 5 years. I'm going to lose the entire exclusion. So in my example, I occupied it for 2. I then rented it for 4 and I sell it. I am not entitled to any of the $500,000 exclusion because I have to have owned and occupied that property for 2 out of the last 5 years. The time after which I met the 2-year threshold, that's considered to be owner occupied also. Next example, the same couple buys a house in January 2009 and rents it out for the first 3 years. They convert it to their principal residence for the next 2 years. Then they once again rent the residence out, this time for 3 years, after which they sell the property for $600,000. So they've owned it for 8 years. They have 3 years of non-qualified use, the first 3 years in which they rented the property, and 5 years of qualified use, which is the 2-year qualifying period. I actually occupy the property, plus the balance of the 5-year qualifying ownership period, following the 2-year qualifying use period. And now, why am I going through this? Because we have this happening with our clients, where people rent, they occupy, and you move out. So your awareness just has to be there in regards to the benefit that may be available to them, to help them so and understand, to speak to their tax preparer. Actually, that's what we want. And also we want to sell property. So tell them, you bought it, you occupied it for 2 years, now you've been renting it for 3 years. You probably should sell it. Otherwise, you're going to lose a $500,000 exemption. So we have to give people a reason to sell their property, because nobody wants to sell their property today because interest rates are so high and they have no place to go. But if it's a tax benefit, that causes people to make decisions differently. So in this example, the gain that we can exclude is $375,000. So the 5 years of qualified use divided by the total period of ownership, which is 8, times the gain of $600,000, that's $375,000, and that's less than the $500,000 exclusion. So I can deduct $375,000 from capital gains, and I'd be paying tax in $225,000.
How is it 5 out of 8?
What was that now?
How is it 5 out of 8 when they've only lived in it for 2 years and then it was 6 years?
That's the exception to the exclusion. That's the exception to the non-qualified use. So non-qualified use, good question. Those last 3 years they didn't occupy it, right?
Yeah.
That's non-qualified use. But there's an exception to that. And that exception is the 3-year time frame following the 2 years of occupancy. So you can add that and count that as a period in time in which you've actually occupied the property. You've got this look on your face. So if you don't live in it, right, it's non-qualified, and that's going to reduce or increase my tax liability because it reduces the amount that I can exclude from income. So the 3 years in advance, remember I'm not going to get the benefit of the $500,000 exclusion. It's going to reduce the amount I can exclude from income. Then 2 years I'll occupy it. But those 3 years following it, that 2 year of owner occupancy, they're going to count that just because that's the rule they made up. Why, we don't know. They're going to count that as being owner occupied. But if it's 3 non-owner occupied, 2 owner occupied, and then 4 non-owner occupied or a rental property, I'm going to lose the benefit of any exclusion whatsoever. I have to start over again and move back into the property.
So they can, after that, they can live in for 1 more year, 4 years of non-renting.
You just need to rent well, actually, you need to remember 2 out of the last 5 years owner occupancy, but then you're going to lose those other 3 years. Suddenly, those are going to be counted as not being owner occupied. It's only the period following the 2 year occupancy period in which you can count up to 3 years as being owner occupied.
And it doesn't need to be consecutive.
No, does not. Does not. Got one more example. I can sense the excitement up there. So Donna has lived in her property as a primary residence beginning 2018. In 2022, she received a new job opportunity, and she doesn't want to sell the property. So she's lived and owned the property for 4 years. Now in 2024, so now she's rented it out for 2 years. In 2024, she wishes to sell the property, even though there have been 2 years of otherwise non-qualifying use as a rental. So the 2 years, theoretically, she didn't occupy its non-qualifying use. So Donna does not have to count the non-qualifying use that occurred after she lived in the property as a primary residence. So she bought in 2018, lived in it for 4 years. 2022, she began to rent it out till 2024 when she wants to sell it. So she occupied it and following her years of owner occupancy, she rented it out for not more than 3 years. She can count all that time as if it were owner occupied. So she would get the full benefit of the $250,000 exclusion. So if she moved out of the property at the end of 2022 and she rented it through 2026, that's a 4 year time frame in which she rented it, she would lose the ability to exclude any of the capital gains. Timing is very important.
Excuse me, the difference between this one and the scenario prior to that is that the first one was bought for the income first,
Right.
and this one was for a primary.
For a primary, correct. So if everybody heard that, difference between scenarios 4 and 5, the first one was bought as an investment property. They then converted to a primary residence.
That's why you use the formula.
Yes, and in this case, yes, they bought it as a primary residence and converted it to a rental property.
What if it's a duplex?
Well, it's an investment property. If you probably can allocate between what is the primary portion and which is not.
And let me ask another question.
Of course you can.
So when in the beginning you mentioned about the short-term gain and the long-term gain, capital gain. So is it different category tax rate for the like a stocks or
No, it's all going to be, it's
All
whether it's earned or unearned income.
that's it?
That's exactly how it's
So
categorized.
one can be opposite the other one.
It can, yes. Capital gains and capital losses, short and long term, can offset each other, for example. But the difference is going to be if it's unearned income, investments from stocks or a sale of a property, most likely it's going to be deemed unearned income. But you, because you're in the industry, you can convert a rental property into earned income by spending at least 500 hours a year managing real estate.
Okay, so we can claim it that.
You
because of
can,
that.
yes, you can do that in that regard. You just need to be prepared to document that if you're audited. So when someone's selling a property, of course, people want to know, what am I going to be paying in terms of tax? Well, that's always a good question. If they've owned it for at least 12 months, they are not subject to short-term capital gains rates. And you can see how high short-term capital gains tax rates can be. They would be subject to long-term capital gains tax rates. And then in addition to that, they may be subject to net investment income tax, or also known as Medicare tax, which is 3.8%. And let me just show you that so you're aware. Now, if I sell investment property and I have net investment income of $100,000, say, and when you're looking at this schedule, if my total adjusted gross income, if I'm an individual filer, single, my total adjusted gross income exceeds $200,000, I'm going to pay an additional 3.8% on my unearned income. So I have total income, let's just say, of $250,000. I'm a single filer, $100,000 of which is unearned income, rents, stocks, things of that nature. I've unfortunately passed this threshold of $200,000. I'm going to be subject to a 3.8% Medicare tax on that $100,000, in addition to paying tax overall.
Can I forward that for my next year too?
Forward.
Yes, like for instance, if the property is vacant and I'm not making anything, but I spend the time there. So can I forward
The loss.
the loss for 3.5?
Well, the question is going to be is you have to be sure that you are active in regards to managing that property, because if you're not actively engaged in managing that property, meaning spending so many hours,
500.
you're going to be limited in regards to taking a total of a $25,000 deduction.
I see.
Whereas if it's earned income or a loss which you're actively engaged in managing, you can use that to offset income. You can take it back, as a matter of fact. So you can refile your tax return. And remember, net unearned investment income is, for example, I have $100,000 in gross rents, I have $40,000 in expenses. My net unearned investment income is $60,000. So that's how it's going to be calculated. And we talked about the holding period for capital gains, 12 months. And the capital gains rates, we talked about that, right? So 0% for the first 2 tax brackets, 15 for the next 4, then 20% over that. And then keep in mind, for an investor who's selling an investment property, depreciation recapture equal to 25% of the total depreciation taken if there's a gain on the sale of property. And then state income tax. So we have federal income tax, we have unearned or Medicare tax of 3.8% potentially. We have state income tax, and we have depreciation recapture. So if someone's thinking about whether or not they want to cash out an investment property, well, you have a lot of reasons to tell them don't do that. You're going to be giving up probably 40% of the gain on the sale of that property. So it's going to be very painful. That is a perfect reason for them to engage in the 1031 exchange. And in regards to tax planning, maybe tell them you have an investment property, move into it, convert it, help them in that regard, give them some ideas, at least what they can talk about with their tax planner to avoid that income tax. It's just massive, as a matter of fact. Pardon me?
Depreciation of the property, can it be used on 1 year, like maybe on the first year, for all the 27 years, or does it have to be?
No, you can accelerate depreciation. So there's methods in which you can increase the amount of depreciation which you've taken, certainly. Then usually a lot of the accelerated depreciation is for the improvements you may make thereafter. So for the most part, you should be able to, if you use accelerated depreciation methods, expense the total improvements made in that year for tax purposes.
Yeah, why can't we have 2 principal residences?
Why can't you? because the IRS said you can't. There's no other good reason, and I can't think of any, at least at this point in time.
And the 1031, the value of this, even you are transferring, the value of the new should be higher than the one that you have,
Equal to or greater than the selling price
Yeah.
of the existing property.
selling price.
Yes,
In
yes,
on the RPA form, I remember there's a section, it's like, it's a primary residence or secondary residence or rental. So for the secondary, is considered primary home or just rental about the tax?
I would investment property.
That's investment.
It would be.
Secondary is investment.
That's exactly how you should be looking at it. It would be deemed to be an investment
So you
property.
kind of have two primary.
You cannot,
No, you cannot.
right? You can only have one primary residence, yes.
Right.
And of course, what's important about that, if you get a pre-approval letter, you want to be sure that the pre-approval letter addresses the fact that it's not a primary residence and is an investment property, because they may not qualify.
Excuse me, you mentioned about the debt that if, it could be prorated.
So what now?
Prorated. So if somebody buy it, how long they were living in there for like one of the spouses passed away.
Mhm.
So it can be prorated, how much they can claim for that. How about the married? Is the same thing?
For married, yes, yes.
If somebody, like you marry someone and after 1 year you want to sell that property, it would,
If you meet the exclusion of unforeseen circumstances due to health, job relocation, then you might be enabled to take a pro rata portion of the exclusion. So you occupied it for 1 year out of 2 years. It's a married
no,
couple.
I mean, one of the spouses is there for more than 2 years,
Got it.
but got married. And after 1 year that got married, decided to sell the property.
Both spouses must meet the use requirement to take advantage of the full $500,000 exclusion.
Both of them.
Both.
So one of them, they cannot. give a
They can take
portion.
advantage of the $250,000 exclusion.
Oh, okay, but not half of the.
Correct,
250.
correct. So assuming there's no specific reasons like health or job relocation, in your example, one spouse owned it for 10 years, that person married, and then their spouse moved in with them and occupied the property for only 1 year, they're only going to be entitled to a $250,000 exclusion. So you need to wait that
Another
time
year.
frame to take advantage of the full exclusion.
Yeah,
And in California, most marriages, there's a 50% divorce rate or greater. And that's another thing, as a matter of fact, I forgot to mention, thank you for bringing that up. But another aspect that could be deemed to be owner occupancy, if it's a couple and they're in the process of getting a divorce, and one of the spouses is required to move out based upon a property settlement agreement or a divorce decree or the judge's orders, that can be deemed to be as if they're occupying that primary residence also.
oh.
Yes.
occupied.
Yes. That's half the married couples in California, right? They're probably not living together in the same property. Okay, any questions from anyone?
I do have a
Oh,
question.
you do? Okay.
This is regarding the people that they want to sell their house and they want to rent it back. I know their rent, when the rent that they are paying is a tax deductible. Would it help them in a capital gain in any way?
Why would the
Because,
rent be tax deductible?
when they are renting
Uh-huh.
back,
They're right, after they sold their
the
primary
amount
residence.
that
Uh-huh.
they are paying for that period, they can deduct it from their taxes. Is it rent?
No, it's not a deductible event. If it's a rent back and they're paying rent, it's not tax deductible. You have this look on your face.
Well, rents is not.
Yeah,
tax
because
deductible,
that's
period.
how I read it, that it's a tax deductible and also they can take advantage of some capital gain. That's why some people, they are renting it back when they sell their own property.
Yeah, there's no deduction
I see.
for a rent back. Yeah. Yeah, even if you prepaid the rent through and it's represented on the settlement statement, it shows rents, it's still, even then, you might take the chance of showing that as a closing cost. It will not be deductible.
Mm.
Yeah, rent in general is not taxable. Anyway,
Not for individuals, no. Just business purpose, you might be able to claim that. Well, great. Well, thanks for coming, everybody. Thank you.
Thank you.
We're done.
We are done. Now you woke up.
Hey,
Hey,
you pay or you pay?
that's the simplified version right there, right?
Right?
Isn't that the truth, huh?
Yeah.
You avoid paying. That's really the goal here. Avoid paying and prolong it as much as possible.
You're the master.
What was that?
You're the master at that.
Thank you.
Thank you.
Thank you.
Thanks, everybody.
Thank you. It was
Sure.
great.
Thanks for coming today. It's good to see you. Good morning.
I'm good. How are you?
All right, thanks, Carlos.